Tesla shares under pressure after reporting a significant delivery miss for the first quarter, 387,000. That was versus an expectation of 449,000. The EV maker noting production setbacks as a reason for the decline in volumes. Dan Levy, Barclays senior autos analyst, joining us now for more. Dan, it is good to see you. So Q1 deliveries much softer than expected. Dan, what drove this miss?
Hi, Josh and Julie. Thank you so much for having me. Look, I think there's a couple things that you saw playing out in the quarter. I think there's weak demand that's likely playing out across a variety of regions. We're still waiting to get the final data, but some of the China data we saw late in the quarter was quite weak. And we know that in the US, there's been some softness as well. So I think we're going to find out the share by region, but that was quite soft. The other thing that we likely saw was that while production was well ahead of deliveries, and there may have very well been some units that were left in transit, this likely implies that there's going to be some further build of inventory. And this is maybe a bit of a challenge going forward, as this now implies potentially further price downs ahead to clear this excess inventory. They likely built something like 45 to 50,000 units of inventory. It adds on top of the, call it 90 to 100,000 units they already had. So extra inventory likely means that there's going to be some negative pricing ahead.
Dan, does that also presume that maybe what you're talking about is not priced into the stock already, that there could be further cuts, that maybe what we're seeing on the delivery side is only the first of perhaps more quarters like this to come?
Yeah, I think there's a couple of challenges that still need to be addressed from a fundamental standpoint. One is data likely implies that you're potentially going to have flat volume year over year, which tells you that we're looking at really a year of no growth, right? This data point that we got implies that to get any sort of growth, we really need to see a ramp of deliveries in the back half of the year. As it was already a steep ramp with volume well in the range of 500,000 units plus per quarter. So one issue that needs to be addressed is the volume side. The other side is around margins. I think there was a view that actually Tesla had been maintaining for a bit more discipline on price, preferring more recently to trade away some volume for price. But I think what we're seeing is that with this inventory build, it potentially implies further price downs ahead. And this potentially implies that you're going to have some weakness coming on margins, really testing the trough that we saw in the third quarter. So there are going to likely be some negative EPS revisions coming.
And I want to dig down also just into China specifically, obviously a very competitive market. What do you see ahead there in that market for Tesla?
Yeah, China has been, I would say, of the three regions, US, Europe, versus US and Europe, probably the most challenging from a competitive standpoint. They've actually held reasonable share within BEVs, call it high single digits, low double digits, depending on the quarter. But what you're seeing is just very intense competition across a variety of automakers, not just BYD, but others as well. I think lately, the competition or the question that's coming up is how do we view the threat from others like Xiaomi that came out with, what appears to be a very compelling offering at a very compelling price point. So you're seeing price pressure in China, you're seeing intense competition. And I think that, region globally is going to be the toughest of the three for Tesla.
At the same time, Dan, it's not like there's no competition here in the US, right? So if we looked at some of the gains that we saw for the first quarter for some of the other automakers in the US, I mean, Toyota seeing a 20% gain, Honda seeing an almost 12% gain. And of course, now it's not just sort of EV to EV, it's also, gas mileage efficient versus EV, right? So how do you think that's going to sort of play out this year as well?
Well, you're right. Tesla has said, think of our competition not just as other EVs, but as other, perhaps comparably priced vehicles or other vehicles in the same segment, in sort of the mid-size sedan or mid-size crossover segment, what would comp against the Model 3 or Model Y. So to the extent that there's going to be more price normalization, and I would say that's a broader theme within the U.S. sales market normalization, as you've seen some inventory normalization, that's going to be some competition for Tesla. That being said, within the BEV market, within the EV market in Tesla, yes, there's more competition. You are seeing everyone sort of increase the product offerings. But what you're also seeing is maybe relative to the expectations we had going into, say, a year or 2 years ago, the growth pace has slowed, right? And I think what this tells you is that others are struggling with EVs from a cost perspective. They can't keep up with Tesla's pricing. And so in a way, I think this likely reinforces what's going to be healthy market share for Tesla in EVs in the US, where they've had roughly, just under half of the total EV market share. If you look at BEVs, it's just over half. You're going to see some share erosion as more competitive offerings come out, but Tesla can still maintain a very dominant market share in EVs, given an attractively priced offering that others just can't keep up with.
Dan, it was great to have you on the show for a big, important story. Thanks so much for joining us.
Thank you so much, Josh and Julie.